welcome to Business Today. I'm Siddharth Zarabi, and here are the headlines tonight. Bulls back on Dalal Street. Markets logged best day in 3 weeks ahead of the union budget. The Sensex ends 814 points higher in a broad-based rally. India is all set for the Modi government's 10th union budget. Finance Minister Nirmala Sitharaman to announce the budget proposals Tuesday morning at 11 a.m. Tune in to watch non-stop coverage on India Today from 7 a.m. tomorrow. The Economic Survey 2022 pegs India's GDP growth rate at between 8 to 8.5% in the next financial year. Pegs growth above China for this year and the next 2 years. Surest signs that the government will loosen its purse strings in the budget for social schemes and capital expenditure. The Economic Survey says enough fiscal space for the government to ramp up capital spending. Tata Steel wins the bid for Odisha-based PSU. Neelachal Ispat Nigam gets the company's 1 million ton steel plant for 12,100 crore rupees. The Economic Survey was tabled in Parliament earlier today, a day ahead of the union budget. The survey, which presents the state of the economy in the current financial year, also gives hints of policy prescriptions in the budget. The survey was tabled by Finance Minister Nirmala Sitharaman. It projects that India's economy will grow at 9.2% in the current financial year and 8 to 8.5% in the next financial year. The projection is pretty conservative in comparison to other forecasts by various agencies, but it puts India's growth ahead of China this year as well as the forthcoming years. There are warnings as far as inflation is concerned, as crude oil is on the boil and threatens the recovery. Inflation is also up and could rise further. However, a big relief to the government is where the survey says that there's enough fiscal space to continue to ramp up capital spending, indicating that perhaps the budget, the 10th of the Modi government, could loosen the purse strings a little bit more. Joining me to discuss the Economic Survey and what to expect in the budget in a few hours from now is a stellar panel. Rahul Bajoria, MD and Chief India Economist at Barclays, Dr. Aurodeep Nandi, India Economist at Nomura, Indranil Pan, Chief Economist, Yes Bank. I'm going to begin by coming to you, Rahul, on the latest GDP projections. And the projections make it clear that we will see a slight decline in next year's growth. And if we look at the 3 years, FY21, the revised number is a contraction of 6.6%, FY22, 9.2% at this stage, and a projection of 8 to 8.5%. What does this tell the average man about how the Indian economy is growing?
Thanks, Siddharth. So I think the way to read this, series of numbers is basically that India did suffer a very large, shock in its activity, indicators in the pandemic year, which was fiscal year, 2021. And then, we have had, I would say, a reasonable recovery, which was also partly hampered by the fact that, we had the Delta wave, at the very beginning of the financial year. But, the recovery since then has been reasonably strong, and we are roughly at the same place where the economy was before the pandemic. So in that particular context, a projection of 8.5%, although we think it might be a tad optimistic, but still shows that, the economy is back on a path where the economic growth outlook remains reasonably resilient. India will be the fastest growing economy, even if the numbers are a tad on the lower side of that particular range. And we reckon that, this particular year will be the year when you really see, India's manufacturing activity improve, there are some tailwinds to be enjoyed. And from that standpoint, we expect these numbers to be broadly realized. And the message is one of resiliency and some hope, for the larger population, to take away from this particular projection.
Indranil, is 8 to 8.5% in line with your own projections? Are there headwinds, for example, oil, that could pose a challenge to these numbers? Your views on this?
Yeah, 8 definitely is higher than our own numbers that we worked our budget estimates for. Our numbers are more closer to a 7.5%. Now, contextually, I think what needs to be placed on the table is the fact that given the advanced estimate is looking at a 9.2%, the second half of the current financial year is likely to be significantly softer than the first half, which clearly, yes, there are some base effects, which clearly also indicates that we are not sure about how the structural sort of positioning of the economy is in the current scenario as we try to get out of the pandemic, and we always keep talking about the K-shaped recovery. How it is supposed to be supporting a relatively high growth rate of 8.5%. So that possibly makes me a bit skeptical about the 8.5%. But having said that, I think the context is more in terms of how the budget numbers are placed, and to that extent, the nominal GDP growth will also be quite sort of important. And given that the economic survey talked about headwinds so far as inflation pressures and global commodity prices are concerned, my sense is that the overall inflation, especially with respect to the WPI, will be strong, which will provide sort of an upward bias to the nominal GDP, and that is likely to help the revenue numbers.
Revenue numbers have been a clear positive, the point that you make, Indranil, but I want to come to you, Oradeep. As far as this year's performance is concerned and some of the commentary in the economics survey, if I were to ask you to sort of read through the fine print and tell our viewers, what does it tell you about the framework and thinking of policymakers at North Block? The way I would like to describe it is that they seem to be very optimistic. This is the third year of the pandemic. The language seems to have far more optimism than we heard even outside the survey several months back.
Yeah, so I think there are a couple of aspects. Right? One is the point you're talking of, which is on growth, right? And again, I think just like my other co-panelists, we have a slightly lower version of growth. Our expectation is 8.7% in FY22 and 7.8% in FY23. And look, I mean, there are various risks at play. But I think that's sort of just one part of the story, right? So you might agree or may not agree with the growth outlook. But I think what's really interesting when you kind of parse through the lines is the kind of broad fiscal policy think that the government has. And I think, excuse me. So there, I think there are a couple of things that kind of stand out. One is it doesn't seem like the government really sees this as a kind of a battle between growth versus fiscal consolidation. I think that essentially the broad sense is that as long as we generate growth, it should help in in controlling medium-term debt. And so there is this sense in the economic survey where they're saying that, look, from a medium-term perspective, we expect the debt trajectory to start inflecting from here. So we are expecting lower debt. Secondly, this kind of focus on capex, which has been pretty evident in government fiscal policy for the past 2-3 years, where there's been a lot of focus on capex. Now this year we have a very high capex target, but the government is so far lagging on it. And what the economic survey says is that, look, this is happening because we've had lockdowns, we've had labor shortages, but coming up we are going to see a big ramp up of capital spending. And so, there is that focus on capex, which I think is very important for the budget tomorrow, because, if that really translates into similarly high capex growth. But the other very interesting thing is this whole barbell strategy which they spoke of, right? Which sort of said that, look, we expanded the safety net for the most vulnerable, but on the flip side, we also remain very fluid in terms of upcoming economic data, and we'll adjust our policy accordingly, which essentially translates to the fact that you could have a large increase in RevX, like it happened this year, in the middle of the year, if the government feels that growth is lagging, or if there is need for some kind of infusion. And so I think from the budget perspective, what this essentially says is that, if you read between the lines, is that yes, there's fiscal consolidation in spirit, and focus on growth in intent, right? So one can expect strong budget on the capex side, and sticky revex revenue expenditure, just based on the kind of indications we are getting in the survey.
Rahul, let's now talk about priorities that should be incorporated in a budget that is coming at roughly the midpoint of Modi 2.0. It is this government's 10th budget. It is Nirmala Sitharaman's 4th budget. Last year was very well received. What are the broad focus areas that you yourself are expecting from this effort?
So, Siddharth, I think one of the key points about this particular budget will be that, obviously with the kind of revenue outperformance we have seen, the total revenue to GDP ratio is now restored back to the pre-slowdown level, right? So in 2019-20, when the new government took charge, the economy was already experiencing a slowdown, and now those revenue numbers have been restored. Our sense is that, the discussion around fiscal space, and, to Aurodip's point that, capex spending has to remain reasonably elevated. How do you continue to do that at a time when you are balancing both consolidation requirement and also, the fact that fiscal support is very important to growth is likely to be a key thrust area, right? So this balance is something that, a lot of us will be looking out for tomorrow in their numbers and also in terms of their guidance. I think one of the key, opportunities, or, this also came out in the economic survey, is that the government was trying to do quite a few things, in the run up to the pandemic. There was a lot of effort to revive growth, and a lot of those things had been put on hold largely because the pandemic took hold. And so, now the government seems to be coming to a point where the mind space and the bandwidth to execute on some of these things is increasing. And, even today we had one more announcement of a potential privatization of a particular state-run company coming through. So I think that probably is something that I'll personally be looking out for, is that how much of an emphasis is there on moving to a post-COVID environment where fiscal priorities will be not just to support growth, but also provide some consolidation pressure.
This is a good point about consolidation. Indranil, how big a consolidation should there be? Should there be one? Or is it time for the government to be cautious, at least till the middle of the next financial year, and see how things are going? Because the third wave hopefully seems to be receding, and we are vaccinated and therefore out of the woods to a large extent.
To put it in perspective, I think the fiscal response of India has been quite different from what has been in the rest of the world. Rest of the world, there was a clear strategy to boost fiscal along with the boost that was provided through the monetary policy. In India, the bulwark in terms of the pandemic support was more in terms of the monetary policy easing rather than the fiscal policy. Now, fiscal policy therefore clearly played on the perspective of the reforms measures and an expectation that private capital investments, private investments will actually pick up. Now that has not happened. That has not happened simply because the consumption is lagging. Consumption is lagging because of some structural issues in the Indian economy, which are likely to have even widened due to the pandemic, which is clearly income inequalities, a significant number of people possibly having slipped below the poverty line compared to the pre-pandemic levels. So some of these issues remain contextual if the government, through its fiscal policy, needs to provide the impetus to growth in an atmosphere where high inflation pressures and unwind of monetary easiness in the US and some of the other economies could actually force the hands of the Reserve Bank of India to tighten monetary policy. Therefore, I am not a voter of consolidation at this point in time, even agreeing to the fact that there is a stress in terms of the public debt. But I don't think this is a year of consolidation unless there is a bigger sort of stable platform that emerges for the Indian economy.
Oradeep, the same question really to you with an edit bit about, after all, how much do you think the current revenue buoyancy that we have seen in this year is likely to last next year? Collections may still be up, but are we going to see continued buoyancy in the form that we have seen this year? Oradeep, that question was for you.
Sorry. Oh, sorry. I didn't realize. So, so that's a very important point that you make. This kind of stellar growth, part of it could be because there might be something structural that has also shifted. But let's not forget, this is coming at a time when nominal GDP growth has been probably 17 to 18%. Now, compared to that, we expect nominal growth next year to be around 13% or so. So I think there has to be some, sense of, sort of realism as far as how much, you'll be able to get from taxes, especially in a situation where, your nominal growth is lower, your raw material costs are rising quite significantly, so your profits are likely to be also hit. The second aspect also is that unlike FY22, we won't be having the kind of bonanza excise collections, from fuel that we've seen this year because those taxes have been withdrawn. So, again, overall, I think it makes, it would be reasonable for the buoyancy to be decent. So around a unity or so, but probably the stellar growth rates that we've seen this year, it's likely to moderate from that.
Welcome back. You're watching the Business Today show. Rahul, let's turn to the management of how the fuel excise duties are handled. You've seen a situation where it became a huge issue, but it wasn't election year, of the kind of continuous rise in the base price as well as the higher imposts. Now, we get the logic of the pandemic dip and fuel excise being used to fill coffers. In November, we have seen a reversal to that, a cut. However, we have also parallelly seen that oil marketing companies are not raising prices since then. Crude oil has meanwhile continued to move northwards. This year is a year of 7 elections, of which 5 are happening in March. What does this tell you about the political economy management? Why not approach it with the same sort of fair, even-handed approach that we see in different sectors? Why is oil special and also not in the GST, Rahul?
Yeah, so I think as far as the the oil taxes are concerned, even if they are not, oil prices are concerned, even if they are not raised in the interim, we do think it's a delayed effect. It's not a denied effect, right? So prices will eventually go up. By our estimates, it could go up by anywhere between 5 to 6 rupees, both for petrol and for diesel. By the time we come to March and the election results are out. And so it will have some inflationary impact. I think the larger challenge, though, is that, over the last few years, oil taxes, ever since, say, 2014 end, when they had come down very sharply for the first time, and the government had fiscalized quite of the gains, to basically reduce subsidies and then to actually increase their revenues. The oil dependency is something that is, increased quite a bit as far as our fiscal financing is concerned. And this is both at the central and at the state level, right? So it's not just the central government which is using oil as a way to finance its revenues, but also the states also are incrementally relying on it. Now, the one way to kind of come out of this particular trap, if we can call it that, is to basically look at other means of taxation. And here the GST is going to play a pretty big role in our opinion, that, as we come to a point where the assured revenues, the compensation for states is going to expire, there could be a discussion between the states and the center to basically use the GST as a way to kind of, compensate for some of these losses, and which will also, then be driven by a much larger base of goods and services, which can provide some alternate, to the entire oil economy, which has a lot of dimensions, not just economically, but also from a political standpoint.
Indranil, on taxation, we saw in 2015 the government virtually junk the direct taxes code. There was a report which has never been made public subsequently. We have seen tinkering, major ones like the corporate tax rate cut, some here and there things on the personal income tax front. GST, as we know, the shape outside of the budget. Given all of this, should we expect anything in this budget as far as taxation is concerned?
Well, I think to a certain extent, as I think I have been pointing out, consumption needs to be sort of looked at. The private consumption demand is still lagging that of the pre-pandemic. Wage growth in the rural segment has been low. People who might have lost their jobs during the peak of the pandemic, some of them, or a significant chunk of them, may have got their jobs back, but at a relatively lower wages. So I think in terms of my own understanding, I think the critical piece that is lacking in the economy is personal consumption, the way it needs to be looked at. And to that extent, the need from the budget perspective is to provide some confidence to the consumers in the economy. That possibly can only be done through the taxes. So one way out, even if it may be relatively unpalatable to people like you and me, is a larger cess on individuals like you and me and in the higher income bracket, to be distributed through lower taxes, or maybe merging of the lowest two tax slabs. And that probably can actually provide some sort of stabilization and impetus to consumer sentiment, and allow consumers to consume in an atmosphere where we have already started seeing deposit rates and lending rates of the banking sector relatively turning, or at least having sort of flowed.
I'm going to thank all my economists here on the panel tonight, and you, the viewer. Thank you very much for tuning in.